Jim, I'll cut right to the chase. You changed the economic dialogue a number of years ago with the request that we find regime change. Are we at that moment right now where there's literally a regime change in our economics where the Fed has to shift the way it does business?
Well, I think for Europe, the ECB is facing a difficult situation. So you might look at that as a crossroads, so to speak, of monetary policy. For the U.S., I think we're, generally speaking, in good shape. I have emphasized that we face some downside risks from the trade war, and I've tried to encourage the committee to take action, which we have, to try to mitigate those risks and keep us on an even keel in the U.S.
What is the urgency of the next number of meetings? We see some houses saying one and done, and I don't want you to game the Fed. I know that's not part of the dialogue, but are we too focused on the one next meeting, October 30, versus the what-ifs of December 11 and into 2020?
I think we'll go on a meeting-by-meeting basis here. The committee has taken two moves, and if you look at my remarks this morning, I think we've moved a lot in the last year. If we were sitting here a year ago, we would have been talking about the Fed raising rates in 2019, not lowering rates. And instead, during January, February, we said we were taking the interest rate hikes off the table, and then getting into June, July, August, September, we started talking about reducing rates. So the shift in monetary policy in the U.S. has been quite dramatic over the last year. I'd say 125, 135 basis points, not just the 50 basis points that we've had. So one part of what we need to do is take stock of where we are, but I think also we have to consider additional insurance in the meetings ahead.
So should the Fed be more aggressive given the risks to the economy?
Well, I mean, if you buy the argument that I just made, we have been pretty aggressive, and normally you would think with long and variable lags in policy that it would take a while for those things to have an impact on actual hard data in the U.S. I would expect those kinds of effects to come online during the second half of 2019, the first half of 2020. And you are seeing some of that in housing markets, for instance, where, say, refinancing activity and other things have picked up.
But you dissented in favor of a half-a-point cut instead of the quarter-point cut. Do you still think next time around that we need half a point cut?
Generally speaking, I'd like to do more, but I don't want to prejudge the meeting. It's let's get to the meeting and make a decision there.